Good morning. On behalf of NYU Law School and KPMG, I'd like to welcome you here to the 15th Annual NYU KPMG Tax Lecture Series. My name is Larry Pollack, and I'm an international tax partner with KPMG and a graduate of the LLM program and the very proud director of this annual symposium. By way of background, this program was created to create a unique forum that brings together professors from NYU Law School, distinguished members of the bar, high-level government officials, and tax partners from KPMG to share their views on a topic of current interest in taxation. Today's symposium will explore whether the U.S. international tax system is really broken or perhaps just in a state of disrepair. Let me paint the picture. The U.S. international tax system is antiquated. Much of the rules and the framework with which we operate were enacted by Congress some 50 years ago, when the concept of a global economy is much different than what we have today. The U.S. statutory tax rate of 35% is at the highest of all of the OECD member countries, although the effective tax rate for many U.S. multinationals is lower due to creative tax planning strategies. U.S. multinationals have great difficulty competing with foreign-based multinationals that are subject to lower corporate tax rates and that are operating under a territorial versus a worldwide taxing regime. U.S. multinationals initially benefit from earning income overseas in foreign subsidiaries at lower tax rates, but then are penalized when they repatriate the profits back to the United States, causing a lockout effect with several $1 trillion of cash that are trapped overseas. This paradigm has propelled the intrigue of many U.S. corporations to explore the concept of what we call an inversion transaction, thereby converting a U.S. multinational into a foreign-based multinational. Through panel discussions, debates, and lectures, our agenda today will be focused on various policy aspects of U.S. international tax. The program is going to focus on identifying the key issues, suggesting possible solutions, and forecasting the future. Our keynote speaker today is Mark Mazur, Assistant Secretary for Tax Policy, United States Department of the Treasury. Following his keynote speech, Mark Mazur has graciously agreed to join a debate session where several propositions concerning international tax reform will be debated. You will have a chance to weigh in with your views during that part of the program. Our distinguished speakers today include from NYU Law School Professors David Rosenblum, Daniel Shaviro, John Steines, Willard Taylor, Alan Viard, and Victor Zonana. From Rutgers University Law School, Professor Roseanne Altshuler. From KPMG, Minal Corwin, Peter Blessing, Patrick Jackman, Michael Plowshin, Tom Stout, Brett Weaver, and Robert Wilkerson. And from the bar, Kimberly Blanchard of Weil, Gotshal and Manges, Stephen Edge of Slaughter and May, London, Paul Oosterhuis of Skadden Arps, Slate, Meagher, and Flum, and Deborah Paul of Wachtell, Lipton, Rosen, and Katz. We plan to open up the floor for audience questions and answers for the last 5 or 10 minutes of most of the sessions during the course of the program. If you wish to ask a question, just raise your hand and a handheld microphone will be brought to you. There will be 2 breaks, one mid-morning, one mid-afternoon, and a buffet lunch at 12 noon. The breaks and the lunch will be held directly across the hall in Greenberg Lounge. With respect to CPE and CLE, for CPE, you just need to complete the evaluation form at the end of the program and hand it in. No need to sign out. For CLE credits, in addition to submitting your evaluation form, to ease the process of exiting, all you're going to need to do is just drop your name tag in a basket that's going to be designed for CLE at the end of the program, at the end of the day, and the CLE and CPE certificates will be emailed to you within 2 months. With that, please put your cell phones on mute, and let's get started with the program. To set the stage for the day, our opening panel is going to provide an overview of the U.S. international tax system and the perceived issues, of which there are many. One of the perceived issues is the political influence over tax policy.
Read my lips.
A research and development tax credit, a low-income housing tax credit.
On principle, no one in America should have to pay more than a third of their income.
I want to cut taxes for 95% of all workers.
On that note, I'd like to introduce our panelists, Paul Oosterhuis and Professor Victor Zanana. Paul is a senior international tax partner in the Washington, D.C. office of Skadden Arps. Paul is well known in the international tax community. Paul is a frequent author and lecturer and has taught international tax at the LLM program at Georgetown and has testified before congressional tax writing committees on various tax legislative issues. Professor Zanana teaches courses at NYU Law School at both the JD and the LLM in taxation programs. In his very distinguished career, Victor was a partner with major law firms and KPMG, and also served as Deputy Tax Legislative Counsel at the U.S. Department of the Treasury. Please welcome our panel. Victor and Paul, over to you.
Thank you, Larry, not only for inviting us to participate in this program, but for taking the incredible amount of time, energy, and devotion to getting this program on and putting it together year after year, and now the 15th year of this event. So we're delighted to be here. Paul and I have been old-time friends. I hate to tell you how far back we go, but I think it was 1975. I was at the Treasury, and you were at the Joint Committee, so we've known each other what is now 40 years, and we're going to carry out a conversation about a few things related to international tax. Our first objective here is to simply talk a little bit about the current landscape and where things stand insofar as the U.S. is concerned in the international tax picture. That first slide is basically a review for all of you who practice in this area or who know even a smattering about this area. So I'll just go over these points very quickly, and then we'll launch into what the perceived issues are. As everybody knows, we have a system of taxation in the United States that imposes tax on worldwide income on both our US citizens, our aliens, domestic corporations, and we provide some relief for foreign taxes that may have been paid on account of activities abroad, on income that may have been taxed in foreign countries through a foreign tax credit regime. Foreign tax credit is generally limited to the amount of US tax that would be imposed on the foreign income, and the limitation is applied separately based on baskets, passive income on one side and general limitation income on the other side. It's not an easy system to follow. It's a relatively complex system. Lends itself to all sorts of tax planning, which the Congress takes from time to time steps to curb and put a stop to it, sometimes successfully, sometimes not so successfully. As far as foreign corporations that are doing business in the United States, they're subject to tax on their activities here. Foreign persons are subject to tax on their US source income, and then the issues there basically relate to what is effectively connected income, what is engaged in a US trade or business, all of which is then modified by the application of treaties, which we have with a large number of countries. Now, the interesting thing that we're going to be talking about is essentially what happens to foreign corporations that are subsidiaries of US corporations. And the regime that we have there is essentially a deferral regime as far as the earnings of those foreign corporations until they are repatriated to the United States. We know that's rules that have been around for a long time. We have had anti-deferral regimes that have been in place at least since earlier than 1962 even, but 1962 is when we saw the advent of controlled foreign corporations and the fact that only certain types of income are allowed to be deferred and other types are not allowed to be deferred. And then the other hallmark of our system that we need to think about very briefly is the fact that we have transfer pricing rules, as do a number of the other countries, obviously. Those are hideously complex. They're not easily enforceable and lend themselves to all sorts of potential abuses. But they're there, and we need to be aware of the fact that they are there. So turning now very briefly to what we see as perceived issues as far as the U.S. tax regime is concerned, especially as it applies to international tax issues. The first bullet point there is simply to tell us that the U.S. tax regime, as perceived by some, is an outlier. What do we mean by an outlier? Well, what we have is a very high tax corporate rate. At least the headline rate is 35%. It's really 39.1% when you factor in the fact that there are state and local taxes involved in the picture. And that rate, as compared to the rate that is applied in other countries, especially the OECD countries, for example, their rate is effectively about 24.8%. So we're looking at a rate of tax abroad at 24.8, a rate of tax in the United States at 39.1%. So that puts us out of sync with the other countries. The other thing that have happened over the course of the last several years, which puts us at odds with what's going on with the rest of the world, is that a number of the countries have shifted to a territorial system. We are still focusing on worldwide taxation, but even some of our major trading partners have gone in that direction. The UK for one, Japan another. The other thing that we have seen, which puts us at a different scale with as far as the other countries are concerned, is that there are incentives in the foreign countries for certain activities in order to encourage them to expand over there. And a classic example of that would be patent boxes, which are now in effect in a number of countries, including the UK. So the argument comes back to there is a great burden on repatriation. The fact that we allowed the earnings to be deferred as far as our foreign subsidiaries are concerned, but then we have to pay the residual tax when we bring them back to the United States. And the argument then goes that this burden of repatriation makes us less competitive. Question one has to ask ourselves really is, what do we mean by less competitive? Are our goods no longer being sold in Europe or the rest of the world? Seems to me that they are. The question is, what exactly do we mean by competitiveness, and insofar as the activities are concerned? So that leads us to basically ask some questions, and that is the deferral system responsible for all that? Is it really a dysfunctional system? What do we attribute this lack of competitiveness to?
Well, I think I would like to focus a little less on the term competitiveness, because that means a lot of different things, and more on the elements of dysfunction that the system creates. And I would identify four. One is the lockout effect. We'll talk about that more on the next slide, because that clearly provides incentives for companies to do things that are not economically functional, if you will, that are dysfunctional. But the second is that it gives an incentive. Ironically, it gives, notwithstanding the lockout effect, it gives companies an incentive to erode their U.S. tax base by migrating IP and other activities offshore. And of course, the way our rules work, it's hard to migrate bare IP. You have to migrate activities along with it. And I think the whole BEPS process is just strengthening the notion that that you don't reward risk on its own. You reward risk that is tied with activities. And that is going to provide a huge kind of leveraged incentive to move more activity. So you're not only eroding the U.S. tax base when you do that, you are you're eroding jobs, sometimes from the United States, sometimes admittedly from Germany or the UK to Ireland or Switzerland, but nonetheless, activities are being moved. And the irony, it is ironic because you'd say, well, the lockout's a problem, so then why are people continuing to base erode? And I think the answer to that is you just think about it from a tax planner's point of view. You don't really know how much of your cash you're going to need back in the United States 3 years from now, 4 years from now, 5 years from now. And so your incentive to reduce your tax rate today, or your incentive to migrate activities abroad, you know, kind of comes first. And so you look at it as, yes, if I can do it, I should structure myself so that I maximize my income that's subject to a low tax rate. And we can then decide whether we can take APB 23 on it and book it at a lower tax rate, or maybe create some deferred tax liabilities in case money comes back, in case we need to bring the money back. And that's one of the things that is fascinating to me over the last few years that just shows the dysfunction, which is the amount of deferred tax liabilities that have been building up. I mean, that's the worst of all worlds because the government's not getting the revenue, the taxes aren't being paid, but the companies are bearing the financial costs from a financial statement point of view. If you had to have anything that would tell you the system is dysfunctional, surely that is it. And we do see billions of dollars of deferred tax liabilities. It's hard to know exactly how much it is. The Credit Suisse report that came out earlier this month was a little disappointing because they didn't try to make an estimate of deferred tax liabilities, but my impression is that it's tens of billions of dollars a year. And that, to my mind, is one of the main dysfunctions of the system. I think a third dysfunction is the incentive to invert. And that's not only a function of deferral and the requirement to have activities abroad and the lockout effect, although all of that is obviously a part of it. It's also a function of the fact that we have relatively lax rules on stripping earnings out of the United States for foreign multinationals. Our 163J rule is pretty, I think, relatively generous to some other countries. And so if you invert, not only can you help yourself, you know, it's as everybody talks about, the three aspects of advantages of inverting. You can avoid the lockout, at least on future earnings. Now, granted, the 2014 notice limits that somewhat, but for younger companies that are growing, they can see that in their future. You can have IP abroad with less activities associated with it because you're not subject to the Subpart F rules. You're out from under, if you will. And you could have more flexibility in capitalizing your U.S. operations. So the fact that the system provides that incentive to invert, to my mind, is a third element of dysfunction. And the fourth is the one that isn't talked about so much, is just the hideous complexity, as we say, actually on the next slide, Victor, if you want to move it. I think about it in terms of some of the issues that we as practitioners deal with our clients. In the foreign tax credit area, in the foreign currency area, in the dual consolidated loss area, just so many parts of the international rules where there's just no way the service can audit it. And effectively, the audit, if you will, is done by your auditing firm in reviewing it. And if they sign off on it so you don't have to book a reserve against it, then you're probably fine because it's an unusual case where it's discovered. And having a system that is so complicated that that's the way it is enforced in so many cases seems to me to be a final element of dysfunction.
I think those are very good points, Paul. The other thing I would mention is one of the items that's on the slide here, and that is the fact that we have had an anti-deferral system in place, at least since 1962, in the way we know it as Subpart F. But in some respects, if you take a look at what has happened to that anti-deferral regime, it hasn't worked very well, or it's being eroded as we go forward. So what started out as what might have been a good idea to basically make sure that we have passive income subject to tax and that we don't have transactions between related parties creating an incentive to move things abroad, we have had an erosion of that over the last few years.
That's true. That's true. I do wonder how much what the impact of that is. I mean, let's face it, the two biggest kinds of erosion that come from check the box and the C6 rules, at least, is stripping earnings out of relatively high tax foreign countries into relatively low tax foreign countries. Example, a royalty that's paid from Ireland to Bermuda strips, income out of their 12.5% rate and gets you down to a 2% rate. Well, the question is, if that went away, wouldn't you still have enough incentive with our 35% rate to migrate your IP to Ireland and to move your activities to Ireland? You don't need the 2% rate to do that. I don't know that anybody's done really a careful study, and I'm not sure how you could do it, to determine whether the things that essentially allow you to strip income, as one example, strip income out of Ireland would change the calculus. Similarly, with jurisdictions like Canada, Germany, and other places where we use interest to strip, it just doesn't seem to me that that's affecting the U.S. tax base that much. It's more affecting their tax base, which is a big reason why BEPS is there and is doing what it's doing, because they're all getting very concerned about that. But I personally think that that has less to do with the dysfunction from a U.S. perspective, and maybe others disagree.
No, I don't disagree with that. I think what the reason these rules have come in, actually, the way check the box has been used in 954C6, has essentially been a way of allowing U.S. multinationals to compete, whatever the word, if you like the word or not, to allow them to operate abroad without having the burden of having the passive income or the type of income that would otherwise be considered business income deemed repatriated back to the United States. So we have talked about some of the perceived issues, and we now want to focus a little bit more on the so-called lockout effect, which I will describe it briefly, and then Paul will launch into what the effects of the lockout are. Essentially, what we're talking about here is the fact that these foreign subsidiaries have had substantial earnings abroad. They have not brought them back home. They have not been repatriated. And the reason they haven't been repatriated is because they would, if they are repatriated, the U.S. parent would have to pay additional tax based upon the 35% less the lower tax rate that was applied in the foreign countries. That's one of the issues related to the operation of foreign subsidiaries. Now, we have some rules that basically tell us that if the foreign subsidiary is deemed to repatriate, then there will be tax imposed at the U.S. parent level on the residual tax. The deemed repatriation, though, can be gotten around very easily, and what we need to address right now is what should we do, or what's the effect of the lockout? To what extent are we harmed in the United States, or harmed in terms of what our operations are abroad as a result of having these lockout effect?
And it's interesting both from a kind of a practice perspective, and economists have been talking about this more. I think we all understand now, and certainly Senator Levin, who was running the PSI committee, made a big point of it, that the lockout doesn't mean all of these monies are invested in Eurodollars or something else. They are invested in dollar accounts. They come back to the U.S. economy. There's nothing wrong with admitting that. That's absolutely true. And that minimizes, if you will, some sort of macroeconomic impact of it. But the company impact of it in terms of distorting their incentives for how they operate their business are substantial. And we're starting to get some academic verification of that in terms of maybe buying things abroad that don't make as much sense. For example, in terms of just the inefficiency in business models of having billions of dollars that are just sitting there earning a short-term passive return rather than being invested in the business. Some of the metrics that analysts use to analyze your business is effectively a return on assets, and if you have a lot of passive investments, that dilutes it, and that provides misincentives for the companies. I think the third is one that's near and dear to practitioners' hearts, which is finding second-best repatriation solutions. We've had, let's face it, we've had a cat and mouse chase for going back to the early 2000s with killer Bs and deadly Ds and Fs, and and all of that, and it's still going on today. The technology changes. You know, you've got between the great accounting firms and the law firms, millions of dollars being spent on advisors trying to figure out holes in the system, and they're there, and sometimes they get wider, sometimes they get narrower, but they continue to be there, and that's dysfunctional. I mean, it would be better if those resources were devoted to other things, I would say. And the final thing is the vulnerability to acquisition from foreign multinationals. There's no question about it, even with the notice, if you do an inversion combination, yes, you can't get access to the cash. But if it's a true foreign multinational, meaning one where the U.S. company has less than 60% of the shares, then you can, where the U.S. multinational shareholders after the deal has less than 60% of the stock of the combined company, you have relatively free access to the cash. And so that does provide an incentive for those kinds of companies to buy U.S. companies. And you know, if it's the irony, if it's really more of an inversion where the U.S. company maintains control of the company, then from an employment and kind of nexus to the U.S. point of view, not much may change. But if it's a real foreign multinational that buys the U.S. multinational, and the real foreign executives take over the company, you can have a material impact on things in this country, and we tend to be steering in that direction in some of the policies that fall out from really from the lock-in.
What's interesting also is that we are also seeing how some companies either get around the lockout or are now basically bringing those earnings back through activities, through actions that they're about taking. And GE is an example of that. They're disposing of some of their European operations, and they're going to have to take a $7 billion hit.
Yeah, I would say that's an exception because they're getting out of a huge business, so it's not surprising that you have to do it there.
And the other thing that you do see occasionally is the ability of these large multinationals with these large cash hoards in Europe or wherever they may be, their ability to borrow, to engage in some activities in the U.S. Apple being a clear example of that, where they were able to borrow several $billions to do dividends or expansion or whatever they're going to do. So it's not all that bad in terms of...
No, it's not, but there are real limits to that. I mean, and when I look through clients that we deal with, sure, a lot of them have done that a fair amount, but they have limits to it. And if we get into an interest rate environment where there's a more normal interest rate, the spread between your borrowing and your investing can be pretty material. So that's not a long-run solution. That's really a patch that allows us to say, okay, maybe we go out to 2017, 2018 before we get this solved. But it's not a stable solution to the lockout.
So let's talk about the trapped earnings, if we want to call them trapped earnings or locked out earnings, and see if there's anything that's going to be done about it. We know that going back to several years ago, we had a repatriation holiday for a brief period of time where we were able, U.S. companies were able to bring back foreign earnings and subject them to a low rate of tax, about 5.25%, and allegedly for the purpose of expanding their activities in the United States. We know that they were used for other things like stock buybacks and dividends. The question now is, what is the administration doing about this? And lo and behold, the Obama administration is finally turning to addressing the trapped earnings and how to deal with them as part of a dual proposal that deals with trapped earnings on one side and deferral on the other side. As far as trapped earnings are concerned, the proposal by the administration, and we're just going to give you a very quick highlight here because there's a long panel discussion in the latter part of the afternoon where Manal Corwin and her team from KPMG and others will be addressing those issues in far greater detail. But in brief, just to give you the 20,000-foot overview, what the Obama administration is proposing is imposing a one-time 14% tax on accumulated earnings in CFCs that have not previously been subject to U.S. tax. So it's a one-time 14% tax. It's imposed immediately. It's effective, at least it's effective on the date of enactment, and it's payable over a 5-year period. Some of the details that go along with that is that there will be foreign tax credits associated with those earnings will be able to be applied against the U.S. tax liability, that 14% tax, but only in the ratio of 14% to 35%. So you can't get more than 14%, basically, in terms of foreign tax credits. And as I said, it's effective on date of enactment, payable over a 5-year period. And the other thing that's to be noted is that these revenues that are going to be generated, and Paul will address the amount of the revenues, will be devoted to infrastructure projects. At least they will be earmarked for infrastructure projects. That's one piece of the administration proposal. There's another piece to it that deals with these issues, and that's the elimination of deferral.
Right, and they do it through what's called a minimum tax, which is kind of a misnomer. We have lots of misnomers. Really, deferral is a misnomer, right? It's exemption until you pay a dividend. It's not deferral, but that's fine. We'll call it a minimum tax for now. It is the only tax, and it really introduces a 3-tier system. You have a complete exemption to the extent of your allowance for corporate equity, which they say is the long-term AFR times your basis and your assets. So that's pretty small, smaller than in some of the other bills. And then a 19% tax on your profits in excess of that, unless it's subpart F income, and then it's subpart F income, you're paying at the 35% rate. As Victor says, we'll talk in a little bit about the revenue from it. They put a per country limitation in to try to keep taxpayers from averaging high tax and low tax for purposes of it. I think that if we are going down this approach, I think that's one area that we all ought to be taking a look at, because while a per country limitation will just be mammothly complicated, and will again have kind of a cat and mouse game of taxpayers coming up with planning devices to try to deal with their per country limits and where they're under 19%, and the government trying to stop it. There already were a couple of anti-abuse things in the Treasury proposal to try to deal with that. So from what I understand, and Roseanne I think knows better than I do, Roseanne Altschuler, but I think it would add a couple of points to the rate if you went to an overall limitation. Yeah. And however we end up sorting it out, if we're going down that road, I think considering having an overall limitation would be useful.
Yeah, the minimum tax is, as you said, it's a bit of a misnomer. What we're really saying is that if you're operating abroad with a foreign subsidiary and you're paying a tax of at least 22.1% over there, that's because of the interaction with the foreign tax credit, then there's going to be no further tax in the United States as you bring those earnings back.
Right.
As long as you've paid at minimum of 22.1% abroad with the foreign taxes. There are also some additional changes that they're recommending with regard to subpart F, but I think in the interest of time, let's move on to the other piece of the administration proposal that we need to just briefly highlight, and that is inversions. Paul addressed the fact that we've had these companies migrating abroad, and what the administration is recommending is changing the basic ground rules as far as whether the inversion is going to work or not work. And it's changing the test basically to say that if you have 50% or greater ownership by the U.S. person, the U.S. former shareholders, then you will be treated as a U.S. corporation as opposed to the prior rule, which was 80%. So we used to have 80%, you wind up being a U.S. corporation. 80 to 60, you lose some benefits. Less than 60, nothing happens. Now, other than the normal 367 rules, nowadays, what we're saying is that, at least they're proposing, is that if you have 50% continuity by the U.S. shareholders, you're going to be treated as a U.S. corporation, so the migration will not work. And then there is a broader definition of what is considered to be an inversion that is based upon the fair market value of the domestic corporation relative to the stock of the acquiring corporation. There's an expanded affiliated group. It has to be primarily managed and controlled. If it's primarily managed and controlled in the U.S., then you're going to be in trouble. And you want to be sure that the expanded affiliated group conducts activities, substantial business activities, in the country of the acquiring corporation. Otherwise, you lose the benefit of your attempted expatriation.
Why don't we go, instead of talking directly about base erosion, let's go to the next slide with the revenue estimate, save a little time, and I'll talk about base erosion in that context.
Sure, let's do that.
This slide shows you the Joint Committee's estimates that just came out about a month ago of the administration's proposal at a 35% corporate rate. I have to tell you, in looking at various reform ideas, it's very hard to get a handle on whether all of this can be an improvement under present law unless you know how the revenue estimates operate, and we don't have a lot of visibility into that. We know the camp revenue estimates from last year, but that was at a 25% rate. We now have another insight into it, which is the president's proposals, and that's at a 35% rate. And there's several interesting things that come out of that. One is when you look at the limit on earnings stripping, which is their proposal to say for inbound taxpayers, the amount of interest you can deduct is the greater of 10% of your EBITDA or the ratio of your interest to assets worldwide as applied to your U.S. assets. I'm sorry, it's your ratio of interest to EBITDA, not assets, in the U.S. compared to worldwide. That raises at a 35% rate, that raises $64 billion over 10 years. It's a huge amount. And it shows you how much, if you will, how much leverage is in the U.S. with foreign companies. And it's something that hasn't been in the tax reform debate until inversions became more high profile last year, but I think will be part of the tax reform debate going forward. And clearly with this kind of revenue estimate, now admittedly if we were talking about a 28% rate or a 25% rate, it would raise less because you stack the rate cut first and these kinds of provisions after it. But nonetheless, the number is big. I think the second thing that's very interesting about this is the amount of revenue that they see as being raised by the 19% minimum tax at $262 billion over 10 years. That was a surprise to me because you do have offsetting, I mean, the lockout effect is gone, and so the income that they're projected to get from dividends over the next 10 years is now being taxed at 19% instead of 35%. But nonetheless, notwithstanding that tax cut, if you will, they're seeing it as raising that much money. If you're really focusing on a system where international is just revenue neutral, not counting the tax on existing earnings, assuming that it has to be a revenue raiser, but that within the ongoing system, it's revenue neutral. So instead of raising $262 billion, it just needs to raise enough to, say, offset the look-through rules and the active finance, and taking into account the earnings stripping piece. We could have a minimum tax that looks quite a bit different, you would think, than the 19% per country minimum tax. And maybe that could be interesting to some folks in terms of proceeding with international reform, even if rates aren't going to be reduced.
Quite right, quite right. I think we are just about right out of time. Just a couple of last-minute final observations, and that is that what's interesting to see is that the issue on deferral and inversions has been joined by the government. It's interesting to see that the administration has come forward with a proposal of the minimum tax and proposals that relate to deferral, and this is now going to move forward, and there'll be more about that later on, I'm sure. And we have just given you just a very brief overview, whet your appetite, and we'll move on to the next panel. Thank you.
Okay, well, thank you, Victor and Paul, for the opening segment, which will serve as the platform for the rest of the program today. Our next panel is going to focus on the base erosion and profit shifting, or the BEPS initiative of the OECD, and the impact of first responders, and in particular the United Kingdom, with recent enactment of the diverted profits tax, or as is referred to, the Google tax. BEPS refers to tax planning strategies that exploit gaps, mismatches, and loopholes in tax rules and in tax treaties that make profits disappear from a tax perspective, or to shift profits to locations where there's little or no real activity, but where the taxes are low. This panel is going to be chaired by Peter Blessing. Panelists include Michael Plowgen, Brett Weaver, and Stephen Edge. From your left to right, Peter Blessing is the head of KPMG's cross-border transactions in the Washington National Tax Office. Prior to joining KPMG, Peter was a partner with Sherman & Sterling for over 25 years and is a past chairman of the tax section of the New York State Bar Association. Peter is also an author of the treatise Income Tax Treaties of the United States. Peter earned his LLM here at NYU Law School. Michael Plowsian is an international tax principal in KPMG's Washington National Tax Office. Prior to joining KPMG, Michael was a senior advisor on base erosion and profit shifting at the OECD. And in that role, Michael helped lead the OECD work on BEPS and worked with policymakers from the OECD and G20 countries in order to develop the action plan on BEPS. Brett Weaver is an international tax partner with KPMG and is based in Seattle. Brett's practice focuses primarily in the technology and telecommunications space and on cloud computing. Brett is the partner in charge of KPMG's tax transparency services and of the West Area International Tax Practice. Stephen Edge is a partner with Slaughter & May in London and is regarded as one of the United Kingdom's leading authorities on UK corporate tax law. At Slaughter & May, Steve advises on the tax aspects of mergers, acquisitions, disposals, and joint ventures, and on business and transaction structuring. In 2011, Steve was called upon to give evidence at the U.S. Ways and Means Committee about the UK experience in introducing a territorial tax system. Most recently, Steve has been heavily involved in consultations with the OECD on BEPS, and in particular in relation to the anti-hybrid proposals. Steve has traveled the furthest of our panel to be with us today, so a special warm welcome to Steve. Peter, I'll turn it over to you.
Thank you, Larry. So I would suggest that if you have pressing questions during the presentation, go ahead and ask them, but we will be allowing about 10 minutes at the end, so if it's easy enough for you to wait, that would be welcome too. So I'm going to turn it over to Michael, who's going to give some general background on the BEPS project and then launch right into hybrid mismatch action too.
Great, thanks. So this panel is looking at the BEPS project, and an awful lot has been said about the BEPS project. So we're going to look at it through the lens, though, of the framing question for this conference. Is the US tax system really broken? And I think you see an element in the BEPS project that some other countries think the US tax system is broken. And now, I don't want to overstate that, right? We all know that BEPS is primarily driven by the political situation in a number of OECD and G20 countries. But I think there are at least two of the elements that were talked about on the last panel that are reflected in the BEPS project. One is this idea that if the US anti-deferral regimes, the CFC regime, is not going to tax the foreign earnings of US multinationals, other countries want to and will. The other piece or issue that was raised in the last panel is this idea that many other countries have been moving away from sort of primarily residence-based taxation, worldwide taxation, toward more territorial and source-based taxation. And so what you see in the BEPS project, in the 15 action items, is really somewhat of more of a focus on source country type solutions to the issues that have been raised. Hybrid mismatches is a little bit of an interesting one because it can be either source country or residence country, but that sort of, again, goes to this idea that if the US is not going to be taxing this income, another country wants to and will. But if you're looking at the proposed solutions for interest deductions, that is more of a source country solution, denying deductions for interest payments. On treaty abuse, again, that is much more a source-based solution for the kinds of issues that have been raised. On PEs and the transfer pricing, at least in the discussion drafts that we have seen so far, again, the emphasis is more on source country taxation than on residence country taxation. There are some residence country taxation type measures, particularly in the CFC area, but you can see the overall trend here. So that's kind of the lens through which we're going to be looking at the particular action items that we discuss. And this is not going to be a comprehensive overview of the BEPS action item. It's really going to be more about some of those areas of tension that we see between the US and other countries moving forward on the BEPS project. So the first one is the anti-hybrid measures. And so this was, the deliverable for Action 2 was released in September of last year. So it's not a final report, but it is agreed, not yet final. There are a number of open issues that are noted in the report, including the impact of CFC inclusions on the application of the recommendations. The treatment of additional Tier 1 capital, regulatory capital for financial institutions and others. But the OECD says these recommendations are ready to be implemented by countries that want to do it. The primary feature of the report is to set forth recommendations for primary and secondary rules to address hybrid mismatch arrangements. And so these are arrangements that give rise to generally a deduction in one country and no inclusion in income in the recipient country, or a double deduction. So think of your disregarded entity that has a deductible payment can be consolidated in one jurisdiction and included as a deduction in the parent jurisdiction as well. Now, a key feature of these recommendations is that they are only going after these mismatches in tax treatment if there is a hybrid element, a hybrid entity, a hybrid instrument, or a hybrid transfer where two parties are claiming ownership for tax purposes in different countries. And on the one hand, you can see that as sort of a principled distinction. The recommendations are not going after tax rate arbitrage. They are not going after the primary use, frankly, of check-the-box arrangements where you have hybrid entities, but the effect of that really is just to turn off the US CFC rules. So the recommendations actually don't go after those kinds of arrangements. And what that means, though, is that can be pretty frustrating because they capture certain arrangements with hybrid elements, but they don't capture arrangements that are very similar but don't have one of those hybrid elements. And so it appears to be generating a lot of work for maybe not that much impact if you look at these recommendations on their own. Now,
that's exactly what we predicted, that this would be so much work and so much compliance effort, and at the end of the day, anybody that wanted to do what they wanted to do was still going to be able to do it.
Right. Now, we do have to keep in mind that there are other actions that may impact on alternative structures, including the treaty abuse action item, the interest deductibility action item, and potentially the CFC recommendations. But the recommendations here in that sense are relatively narrow, notwithstanding some of the sort of breathtaking jurisdictional issues that we'll come on to. Another key point here is that the governments recognize that not everyone will adopt these recommendations, right? So the idea is to give interested countries a toolbox to address these issues, regardless of which side of the transaction that they're on. So the primary rule in most cases is to deny a deduction if there's no inclusion on the other side. The secondary rule, sort of backing that up, is to deny an exemption or force an inclusion if the payment is deductible in the payee jurisdiction. On top of that, and we'll go through an example, there is an imported mismatch rule that says even if you've got a straight debt transaction between two jurisdictions, no hybrid element, if that income on the other side is offset by another hybrid mismatch between the second and third jurisdictions, then the deduction can be denied on the straight debt arrangement, which I think is causing a lot of concern and is very surprising to a number of people. And maybe we'll speak very quickly about where the U.S. is on this. So certainly U.S. law already deals with a number of the recommendations in the Action 2 report with the DCL rules, the 894 rules on domestic reverse hybrids. And the administration has put forward proposals that are consistent with the OECD anti-hybrid measures. Chairman Baucus's proposals also include anti-hybrid measures. And certainly the Action 2 report is a consensus document, so the U.S. has supported or at least not objected to that document. But enacting those recommendations in the U.S. To the full extent would clearly require legislation, and later panels will talk more about the prospects for that in the U.S. In the near term. But again, I think the idea is that regardless of what the U.S. does here, other countries are moving forward with this, and the rules are designed in a way to allow other countries to tax these types of arrangements if the U.S. does not move. And maybe we'll come directly then onto sort of the example that I think is perhaps most illustrative of this. So this is a U.S. parent with a Luxembourg finance company that is funded by PECs, TPECs or CPECs, treated effectively as debt in Luxembourg and equity under U.S. tax principles. The Luxembourg finance company then makes a loan to a UK operating company, straight debt, no hybrid element, and the Action 2 recommendations would say that in this scenario, if the U.S. does not implement anti-hybrid measures, and if Luxembourg does not implement anti-hybrid measures, then the U.K. Can deny the deduction on the straight debt between Luxembourg and the U.K. And so these rules will have a very significant impact right off the bat. And so I think the reason we use actually the UK in this example is that the UK has announced at the end of last year that it intends to adopt these recommendations, which again will have a very significant impact on US multinationals. Coming into effect, it's planned starting January 1st, 2017. Right? There are a number of differences between the UK consultation document and the Action 2 recommendations. And Stephen, I don't know if you can speak to whether those differences are intentional or what the UK plans to do.
Of course I can. And Michael's example here, of course, illustrates one of the fundamental design principles that's within the BEPS process. As Peter said, when this started out, I asked the OECD people whether the rule should be that for every deduction there shall be an inclusion, because if that was the answer, then it seemed to me we were generating thousands of jobs around the world trying to track down where interest went and whether people paid tax on it and whether it was right or not. But if you also ask yourself the other question, which is whose base are you seeking to protect? In this case, again, as Peter said, if the UK had borrowed plain vanilla debt, we'd be looking at a whole raft of rules we've got in the UK to protect the UK base, but we wouldn't be looking at these rules, nor would we be looking at the anti-hybrid rules that the UK itself introduced in 2005, and which have now been operating for 10 years. So what is happening here through the implementation of BEPS is that unless the US changes its system and includes this income, then the UK is going to end up taxing more from an equivalent operation than it would if that debt was plain vanilla from an outsider. And I look at that and I think, well, that's either going to cause an enormous battle to break out between the developed countries, or alternatively, it's going to give the UK an unfair advantage. So anybody who's looking at this from a UK point of view would say, well, that looks like upside to us. Equally, the other way around, UK companies putting financing into the US are worried as to whether the interest limitation rules or indeed whether US reactions to inversions are going to mean that the US deductions are reduced, the earnings stripping rules change, and also whether or not it's going to be possible for UK companies to finance their US operations through hybrid debt. As to why the UK has come up a little bit differently, I think the UK would have preferred something that just protected the UK base. And as I said, we've had 10 years of experience of anti-hybrid rules. And I think they've left a little bit of wiggle room in the way in which they've brought in the rules so that they can bring in the rules, comply with BEPS, but at the same time continue to have a competitive tax policy, because we're very much alert to the fact that operating within the European Union with a very open economy, we need to attract people in and encourage them to stay.
Great, thanks. The UK is clearly a first mover here, as it is in a number of areas in BEPS, but the other countries are very much moving forward on this as well. The German government has proposed adoption of the Action 2 recommendations, and we'll be debating that over the course of this year. Many other countries have either proposed anti-hybrid measures or implemented them over the past 2 or 3 years. So this is clearly an area where there's a lot of movement.
Yeah, the French have brought them in as well.
Yes.
And of course, there's a potential triple whammy on that structure as well. And if you run into a state aid problem in Luxembourg, then you can lose in every jurisdiction in the world if you want to.
Right. Absolutely. I think with that, we probably should, in the interest of time, move on to permanent establishments.
Okay, thank you, Michael. So this segment's called Redefining PEs. This slide gives a nice overview of what is proposed in Action 7 and what's not proposed. So, for example, there's nothing in the Action 7 document about digital economy, which is not unexpected, but it's interesting that the actions proposed are really very conservative in the sense. They all hang on the traditional concept of contract. So everything centers around a contract. One could have gone the other way. The diverted profits tax that Steve's going to talk about did go the other way. But this, I think of as actually pretty good news when we get into it. Behind all of this is the question of why are they trying to expand the definition of PE. And some of it goes to what Michael just said, that the source countries, some of them are clamoring, but more importantly, all countries are seeing that because of tax competition, they can't tax on a residence basis. Countries like, I won't use names, but certain countries that don't have a large domestic tax base are on the other side of the fence, and they would like things just to stay as they are, naturally. But most countries, surprisingly, we would think that a country like Germany, France, why does it want to expand the concept of PE? Simply because they're not taxing on a residence basis. They might as well tax on a source basis. But these proposals are not enormously broad. So the first area that we're going to talk about is dependent agent, the expansion of paragraph 5 and 6 of Article 5, and then paragraph 4, which is if you do have a PE, are you out under preparatory and auxiliary? And there are certain proposals in that context. And then there are certain time requirements for services PE or building installation sites and so forth. And there's a proposal about splitting contracts there. And the last segment is a proposal on insurance. So let's just go to it. Paragraph 5, the proposals deal with essentially break it into 4 options. And each of those options are composed of 2 different sub-proposals. And the first set of sub-proposals is trying to deal with the what kind of activity you need in the host state. It used to be, or it is currently, concluding contracts. Now, we shouldn't be too wedded to that term because the current OECD commentary says concluding contracts includes substantially negotiating the terms of the contracts. So, when the proposal here is negotiate material elements, some of the comment letters said, well, that's fine, but make sure it's got to be substantial negotiations. The problem with that comment is it's already substantial negotiations. And the second area that the focus is on is what's the relationship with the home country enterprise? Does it have to be does it have to be sort of amorphous, or should it be rather precise? The precise alternative was some sort of a legal relationship. So by virtue of a certain legal relationship, the contract was entered into. So suffice it to say, of these four options, the option that was most people in the practitioner community espoused was the one that had the brightest lines and was the narrowest, and that was option D, because option D, in terms of activity in the contracting state, said, negotiate material elements of a contract. Well, that's, how different is that from substantially negotiated contract? And as far as the connection with the home enterprise, you had to have a legal relationship, which is a pretty, at least a defined, and it has to act for the account and risk of the enterprise. That's pretty close to today's law. So if they went with option D, I mean, I don't think that personally that's a lot of change. So let's look at what one of the targets. The only target that truly has been announced as a target is the commissionaire. So in a commissionaire arrangement, it's a product of laws of certain European countries that allows basically an agent, literally an agent in the home state, and that's B in this diagram, to enter into contracts that basically are for the account and risk of the A home enterprise, but just not in the name of that entity. So they're in the name of the commissionaire. So this would be knocked out under any of the four options. And really only one piece of it is needed to knock this out, but it's knocked out under all of the options. So the question comes up, if they just want to get commissionaires, why wouldn't they just say commissionaires are no good? So they must they say commissionaires in similar arrangements. So what's a similar arrangement? We are pretty sure that what we like to use, low-cost distributors or basically buy-sell arrangements is not intended to be covered. But the action plan does not say that. The discussion draft does not expressly say that. But it's sort of implied. There are, commissionaires that are not subsidiaries like this one is, and so they are not exclusive. They might be independent enterprises. Those would not be covered. And what if the commissionaire, there's a concept in Europe of commissionaires del credere, which they basically have risk of collecting the receivables. It's not clear that those are covered. What if you have a broker or a marketing agent? Those would be covered under two of the options, but not option D and not option B. They'd be covered under the options A and C. So there's some uncertainty here. The proposal that would actually catch a lot of things is including marketing and brokers, and I wonder about would it catch low-cost distributors in certain cases? Possibly, I guess. Steve, what do you think?
I always think that if instead of using a rather fancy term like commissionaire, we talked about an undisclosed agent for an undisclosed principal, then we'd all understand what we were talking about, because that's all it is, and an undisclosed agent for an undisclosed principal can have to stand behind the credit of their principal, which is what the del credere agent is. So I do think there's a bit of smoke and mirrors with commissionaires, frankly.
Well, you're talking about a synthetic commissionaire, and that is covered.
On the limited risk, I think it just depends on the substance.
Yeah, limited risk, I would think, I don't know where it comes out under DPT, but maybe we'll hear that later. So another example is a remote seller of goods and services, and in light of time, we go pretty quickly here, but basically B in this example is acting as a feeding and caring for customers, and it also is hosting website service. And the question is whether this is a problem. The activity of B company in marketing is along the lines of what I just said. Under two of the options, it might actually be considered to create a PE. Under two of the options, it would not. If it's got a hosting device that's actually accepting orders, that's a different story. One would think it likely would be a PE. There's been case law in Europe that whether you act without employees through devices or machinery to engage in business, is not relevant. It's not necessary that one have an employee. It can still be a PE. Now, I'll just go real
Peter,
quickly here.
Yeah, if you don't mind, just one quick comment on that.
Yep.
Your earlier lead-in on this Action 7 indicated that there wasn't anything specific on digital economy and some of the concepts that were raised in that report, such as maybe economic nexus, et cetera. But to that point, and as this illustrates, option A, for example, would be one that might be kind of a surreptitious view of economic nexus, right? Because that loosely defined interaction that BECO has with customers that gives rise to a contract to AECO, it's an interesting question as to whether this is essentially economic nexus in disguise.
Yeah, even A and C, which have that, as Brett says, loosely defined economic connection. Actually, in a paragraph in the discussion, they say there's got to be a direct causal connection. So it seems to me it's much tighter wound than it seems at first glance. But I think we all agree that that part of options A and C is a real danger if it were to come in. Now, none of this would be of any significance or not much significance if they didn't change paragraph 6, since people have been taking more and more aggressive or well-planned positions, depending, to be independent and to argue that their subsidiary is independent. So this Action 6 change would change that and essentially say, if you're acting exclusively or almost exclusively, then that you're never going to be independent. It's unclear how this comes out. It's really an important issue. And I said at the beginning, a lot of this, why are we going through all this? Is revenue going to be raised by this? So just to, I think we're going to move on very quickly, so I'm just going to say, we have a warehouse example. Let's take a warehouse example. How much B is operating a warehouse on behalf of basically the goods that are stored are A's goods. This is, in a sense, it's a preparatory and auxiliary example because warehouse is one of the protected activities. You might not even get to the preparatory and auxiliary if you respect BECO as a separate and independent enterprise. But let's say it's not, and let's say they can say that the warehouse is at the disposal of AECO. And the preparatory and auxiliary provision is changed to make it like it is in a number of treaties with Asian countries. And that says a warehouse is okay, it's preparatory and auxiliary, as long as it's only for the, quote, occasional delivery of goods, but not if it's for constant delivery of goods. Okay, so they say the warehouse is a PE. How much value is attributable to that? Is all of this worth the candle? It also brings up the question of, is it good policy to create a further distinction between pure digital services, which would never have this issue, and digital delivery of physical goods, which does have this issue? And we're really distinguishing enterprises to a very large extent in terms of their taxability. And I think with that, I will, in the interest of time, pass it on to Brett.
Great. Thanks, Peter. Yeah, let's jump into the next issue that has certainly caused some concern, I believe, from a U.S. tax perspective, and we'll talk a little bit about some of the transfer pricing measures. First up is the draft on risk recharacterization and special measures. The draft was issued in two separate parts. The first part focusing primarily on identifying the transactions, what the draft terms is delineating the proper transaction, which indicates that you start with the contract, but it is interesting that it mentions that's a starting point, right? And then you need to move beyond the contract, look at the actual behavior of the parties to properly delineate the actual transaction between the related parties. So that's largely part one. Part two focuses on the application of issues around transfer pricing that may be outside the arm's length standard and focusing specifically on special measures, et cetera. So that's roughly the issue. And I think a good way to illustrate some of the concerns around the risk and recharacterization draft would be to cover one of the examples. This is an example in the draft that addresses product recall risk, and the facts of the example: two affiliates, one a manufacturer, the other a distributor, and between the distribution, within the distribution contract, rather, with the distributor and the manufacturer, the parties have decided to allocate the risk of product recall to the distributor. And the example goes on to note that the companies have actually never experienced any product recall. But having said that, since the risk has been allocated contractually to the distributor, there have been some incremental returns that have been allocated to the distributor because they have borne that risk, and of course because there's never been actually any loss experienced. The example goes on to indicate that the manufacturer is solely the person, right, the party that's involved in selecting suppliers, dealing with quality issues, monitors the quality process throughout the manufacturing process, et cetera, and is constantly involved in improving the manufacturing process. The distributor, on the other hand, really, it goes on to indicate that it really has no capabilities to address, product quality issues, to deal with the supply chain, et cetera, that it's really largely customer focused. And as you can see in the excerpt here on the slide, the example concludes that, because the distributor really has no capability to manage the product recall risk, that essentially the contract should be disregarded and the risk of a product recall should be borne by the distributor. So a very interesting conclusion essentially is taking the contractual arrangement between third parties and throwing it out the window. It raises some very interesting questions. Obviously, that's a step to the allocation of the profits related to that risk of being reallocated back to the distributor. And you could see why taxing authorities may want to do that. But an interesting question is, what happens when we actually experience a product recall? Right? We really have some losses. Is jurisdiction A and the manufacturer jurisdiction going to raise their hand and say, yeah, those losses belong over here in this jurisdiction, right? I'm somewhat skeptical with that, and it creates a really interesting position for taxpayers to be in terms of trying to plan and put in place their arrangements with the view that essentially your contractual arrangements could be second guessed. And I don't know, Stephen, maybe I'll turn to you here. I mean, clearly there's been a lot of concern expressed by U.S. taxpayers and the U.S. government on this issue of setting aside to some degree, contractual arrangements. How has this been received from a U.K. perspective?
Well, we had some outbound transactions where people transferred the U.K. phrase, you'll probably remember it, Brett, that was used was the crown jewels. You don't transfer your crown jewels offshore. And the advantage of having a monarchy still. So the UK revenue wanted then just to ignore them and say that never happened. Terrible dream. The brands are still owned in the UK. And the answer to that, I think, is, well, actually, no, you can't imagine we have not done a transaction we've really done, and your task then is to price it. I very often come across this product recall point, and you're right on that when people are trying to attribute significant consideration to it, the key question is, well, how often did it happen? And I, at that point, always mentioned the name Perrier, because when it happened big time with Perrier. You had to withdraw stock from all over Europe. So product recall may be a small risk, but would I take it for a small consideration when it's going to be a complete disaster? No. So I do see there's a bit more credibility, and that's maybe Andrew Hickman, who lately of your parish, and of the Revenue, who's expressing it a bit more clearly. But I think in order to recharacterize, you've really got to have no substance to the arrangements that you've done. If you've really done something, you've done it, I think, and you've got to respect it. Sorry.
Yeah, you can take notes. I mean, even today, a big recall was announced by a company called Bluebell. They found some Listeria in like two of its ice cream cookies, and they're recalling everything. And they said this is just the way to do it. Back to you, Brett.
Great. Well, all interesting points, and you mentioned the word disregard or recharacterization, and it's interesting to note that issue that we just walked through was within the concept of Part 1 as it relates to delineating the transaction. There's a separate section which really is labeled non-recognition, and that's one where if the transaction entered into between related parties is deemed to be a transaction that is indicated here, right, lacks fundamental economic attributes of an arrangement between unrelated parties. In other words, that's a transaction that third parties would never enter into. In that instance, the entire transaction could be disregarded. And of course, there's concern there in terms of how you would distinguish those types of arrangements. So I think we've covered this one for the most part. I think the major concern with the draft is this issue around respecting the contracts. And there has been enough discussed about this that the Secretariat has announced in the last several weeks that there will be, I'll put it my way, right, maybe much more of a, not much more, but at least a relaxed focus compared to what we have now in the subsequent report that we might see kind of post comments having been received on this initial draft. Excuse me. I think the other point to note here is the emphasis around decision making driving a lot of where risk and where profits ought to be allocated. And as indicated in kind of the final bullet here, that's also a very difficult issue to address. And again comes back to this respecting the contracts. If the contracts allocate risk and asset value to a particular party, but yet if our focus for transfer pricing moves more toward where are the decision makers, less so the contractual party that bore that risk or has responsibility with respect to those assets. Again, a very difficult rule to actually administer. Decision makers, they're people. They're mobile. They might be in company A today and company B in a different jurisdiction tomorrow. Does risk and and rights to receive returns move around as people move around? Very difficult to administer that concept.
Brett, I might just mention in the state aid Starbucks decision, there's some very frightening, concepts in terms of whether the commission and whether if it does, whether the ECJ upholds it, can basically create a different playing field for transfer pricing. Basically, create this concept of independent market operator and say, if I'm an independent market operator in this particular jurisdiction, I won't give away my profits. I won't give away my residual profits and just operate. I just won't do that. And that's sort of a transformational way of thinking about transfer pricing. The other thing is variable in the same sense, variable royalty, paying out the residual profits after keeping the routine profits. No, it's not a royalty. We don't think that's a royalty. And so there's that Starbucks decision, I think, or proposed decision is interesting.
And there are things you would do, aren't there, in the context of a joint venture that you might not do with a wholly independent party. And so it always seems to me when the tax authorities go into denial and say you wouldn't do that with a third party, the answer is if a third party becomes your joint venture partner, you would do it, in which case then the usual response is, okay, well, that's a profit share. And that's not necessarily a bad outcome.
Okay. Well, Stephen, that's a great lead into the next topic, which is profit share. Right? You're an excellent plant. So, and I think interestingly, to your point that you stated that's not necessarily a bad outcome, and I think beauty's in the eye of the beholder, right? And a lot of that is dependent upon how it's actually implemented. right? So the discussion draft here, I think it's interesting to note that this one is not a consensus draft. It was designed to stimulate comments from the business community and others. It listed 8 different scenarios that seemed to imply that these were fact patterns that use of profit split would make sense. I think it's also useful to look at Action 10 in terms of the directive in the BEPS action plan, that it highlights that, with the concerns of highly integrated multinationals, that profit split method may be the appropriate way to arrive at a proper transfer price. So that's highlighted as potentially one of the fixes here, right? So I think it's illustrative as we go through the paper and look at some of the examples in terms of at least the initial thinking that the Secretariat had around around profit split. And as Stephen mentioned earlier, Andrew Hickman, who's leading the transfer pricing effort, is very much a fan of profit split. And I think some of the initial reaction that the business community had around the profit split, he mentioned it a few times, was somewhat disappointing. So it'll be interesting to see what the next iteration comes out with. Having said that, a couple of key principles. The document seems to indicate repeatedly that when you have multinational enterprises that are highly integrated, and to some extent they've maybe fragmented their activities. We have warehousing in this company and distribution over here, we have R&D over here, that trying to identify comparable transactions using one-sided transfer pricing methods, that I can separately identify the value that I leave behind for contract R&D. And I can separately identify the value that I leave behind for the distribution function. Add up all the pieces and the residual falls back to some entrepreneur, oftentimes located in a lower tax jurisdiction. That the general concept of this paper is that those types of approaches to transfer pricing, which is historical transfer pricing, really lacks comparability. That to compare a company that just does logistics to an integrated multinational that really can kind of control all of this across the board, across many countries, really it's not comparable. And therefore, it lacks reliability, and a profit split is essentially a better method. So that's largely a theme of the paper and the 8 examples that are included. Let's just cover one briefly in the interest of time, and then we'll end this section. And that is this example. We have a parent company that owns intangibles, both R&D, IP-related, and marketing intangibles. It also manufactures product, which it sells to its affiliate, ESCO. And ESCO is really a very successful distribution company. The example notes that the industry that P and S are actually in is very competitive, and that ESCO is very close to its customers. It helps them in terms of integrating products, figuring out how to design and configure your products. There's a high degree of sensitivity in terms of being able to track maintenance of products, and they have kind of an automated process to help companies get ahead of their maintenance schedule, et cetera. So they walk through all this value, right, that S adds, and concludes basically at the end of the day that because S's contributions to the overall value chain here are so unique and valuable, that it suggests that use of the profit split method would be appropriate. What's interesting, I think, for many taxpayers in this example is that a lot of what was described what ESCO does is what you'd expect almost every distributor to do, in my opinion, right? Which is stay close to your customers, right, and help them with product selection and all the rest of that. So I think it does raise some really interesting questions. Is this the type of fact pattern that would lead us toward the use of profit split? And even if it did, right, the question then becomes one of, would profit split really be that much more reliable than some of the other transfer pricing methods? And once I get to profit split, how do I split the profit? What's my key? Right? If one party's adding value through bearing of risk and controlling risk, and another party's adding value through functions such as manufacturing, what type of allocation key do I come up with that? And if the key is more arbitrary in terms of measuring that value by the two contributors, have I really ended up with a method using profit split that's more reliable than any other method? So with that on profit split and some of its concerns, let's move forward to...
I would suggest we jump to diverted profits tax in the interest of time, to leave time for questions.
Okay, so
we can come back. If
I'm here as chief apologist and to take the blame. The two key things I think to note about diverted profits tax from a UK point of view, and I know it's got a certain amount of notoriety over here, are one, that we're in the middle of a general election in the UK, and it's going to be one of the tougher general elections for a number of years. The outcome's generally genuinely uncertain. The Chancellor asked of Treasury officials before the election campaign started, give me something that I can point to when the opposition accused me of being soft on multinationals, particularly the US multinationals who've, in the rather febrile environment we got in the UK at present, have attracted some criticism before the Public Accounts Committee. I don't think the Treasury called it the Google tax, but it's no secret that they were not displeased that that tag was attached, because that came in train with the idea that this was the UK government being toughed on US multinationals. And the people in the streets, of course, like all of us, think that tax is great so long as it's paid by someone else. And the idea of taxing all these multinationals who are making huge money in the UK is great news. Giving the Google tax tag to it gave the impression that we were also taxing digital transactions, which of course we're not. So the second point I think to note is that the title, a diverted profits tax, along with a lot of the publicity, has been misleading. The government at this time is not the least bit worried about that, because actually it gives the right impression to the people who vote. It will become worried after the election if it has an impact on the government's competitive tax policy, which is partly designed to keep the multinationals that we've got. Don't have as many as you, but we do have a few. And certainly what happened in 2007 and 2008 was that we were suffering inversions before you did, and within the European Union we couldn't close the door. So we had to accept very quickly that the only way we could keep people in the UK was to change our tax rules to a territorial system. On the inbound side, we need to make the UK an attractive place to do business, and we've changed our tax administration. It's much more open relationship, real-time working, but we've also got a really good relationship between business and government in terms of tax policy. Most tax proposals in the last 5 years, maybe more than that, have been consulted on, announced, and dealt with. Diverted profits tax wasn't, so it caused some annoyance in the UK community as well. But as I said, it's an election trade. Now, diverted profits tax suggests that profits are being diverted from the UK, they belong somewhere else, and the UK is reaching out to them to try and tax them. And that's what's given rise to the allegation this is a BEPS first mover. If actually what the government had announced was that it was putting in place stronger measures with greater penalties to improve its transfer pricing regime, which is actually, as you'll see in a minute, I think the truth of the situation, in the context of an election, that would have done more harm than good, because immediately the opposition, Margaret Hodges of the Public Accounts Committee, who is not Mrs. Thatcher returned, by the way, who's been haranguing everybody in sight from the revenue through to all the multinationals who appeared before her, would have said, so you've only just realised now, after I've been shouting at you for the last 5 years, that you need better transfer pricing rules. But interestingly, and I'll come on just a little bit and then we'll finish for questions to the detail of the rules, that the yield shown for diverted profits tax, which is a 25% rate, so 25% higher than our UK corporate 20% rate, goes up. So over the first 3 years of the tax, it's a relatively low yielder. The government say they will collect about £1 billion, $1.5 billion, from diverted profits tax. If you've got a tax that's coming in to discourage people from playing the fool, you'd expect it to go down. So the first question I asked is, why is that going up? And the answer is a rather revealing one, because they say, well, what diverted profits tax is going to do is give us more information. It gives us a cosh or a blunt instrument that we can use to threaten multinationals to give us more information. And therefore, actually, the yield from diverted profits tax that we show in the announcement is not all diverted profits tax. It's actually improved corporation tax from better transfer pricing. So I think the right thing to do is to look at diverted profits tax as an adjunct to transfer pricing, in the same way that when we changed our CFC rules in 2013, we effectively brought into our transfer pricing regime into our CFC regime, transfer pricing rules, that looked at whether the UK base was being eroded or whether the profits in a CFC really belonged offshore. So if you then look at the design principles on diverted profits tax, first of all, why did they choose to have as the two threshold entry conditions the fact that you've got low tax profits, less than 80% of the UK rate, and the UK rate is quite low already, as you will recognise, and insufficient economic substance in the jurisdiction in which those profits are accruing to justify the profits that are being made there. The answer to that is that the Treasury said, we've only got so much time. We can't look at everybody all around the world, but actually if we see pots of untaxed income somewhere in the world, then something's gone wrong somewhere. Because capital on its own, as Paul said earlier on, doesn't make anything other than a passive return. You need to have activity or people to manage intellectual property and make the super profits that are being looked for. So if you've got insufficient economic substance but large profits, something's gone wrong. Looking at it from the UK point of view, therefore, the UK revenues say we've, over the years, been frustrated by our inability to look beyond, in transfer pricing terms, the leg that comes into the UK. So the example that was given earlier, Bermuda, into Ireland, into the UK. The UK revenue would say we just get told what comes into the UK and all we see is the license agreement between Ireland and the UK. We don't get, unless you've got a really open and compliant client, who are all mine, people who will give us details as to where the R&D is done, where the profit is really made. And unless we get a global picture, we won't really be satisfied that we can positively say where profits belong, as opposed to negatively say they don't belong here. It's always difficult to prove a negative. So from our point of view, diverted profits tax is intended, say the revenue, to give us better access to information because we've got this big cosh of a 25% charge and some pretty severe penalties to make sure that people tell us what's going on around the world, and we can then work out whether or not any of the payments that are leaving the UK, the so-called tax advantage payments, are inflated payments from a UK point of view, so the UK base is being eroded, or whether they're justifiable payments going out of the UK and actually some other jurisdiction, possibly the US, is losing out on not taxing that income. So very quickly, the diverted profits tax regime has said I've got two low threshold entry points, insufficient economic substance, low tax profits. It's got two limbs to it, the avoided PE rules, which say that if you've designed a structure so that you don't have a PE, then you do. And as Peter was saying earlier on, I find the idea of somebody just sitting in a field in the middle of Ireland or in the middle of Switzerland and just signing every contract that's put in front of him or her an odd one. I don't think that attracts value. The tax advantage payments, and this is the key thing about the diverted profits tax, looks at is a straight transfer pricing. The consequence, the amount that's subject to diverted profits tax is the excess payment that is being made because you are attracted, you become exuberant at the possibility of clocking up offshore income. Actually, when you do the examples, and I've worked with the revenue on the examples that are in the guidance that have come out, it's quite difficult to find clear examples without imputing stupidity to your clients. You know, we were paying this today, we found this great structure, let's just put the cost up by 10%. You're caught bang to rights at that point. So my optimistic nature says, I think particularly after the election, if we have a continuation of the current tax policies, diverted profits tax will not cause any damage for inward investors and will gradually settle down. But there will be a few people out there who will find that when they thought they had an APA in the past, it gets reopened because their revenue didn't feel that they had full disclosure in the past. As Brett said earlier on, well, the revenue shouldn't have signed the agreement, should they? But they did. My worry on diverted profits tax is that it is going to be implemented by quite a wide number of people across the UK, and just as here, there are people who joined the Orchard Brigade when they were young and are in life to make difficulties for others. So that could happen with an unsympathetic regime at the top. It could get worse. But certainly the message at the present from the revenue is that it is not a BEPS first mover, it's just seeking to improve the UK's collection powers.
So, Stephen, I guess Both of the prongs that you talk about in terms of avoiding PE and improved transfer pricing are also part of the BEPS project. Is the diverted profits tax intended to be a temporary measure until the BEPS project is completed on those issues, or how is that viewed?
When I asked that question, the Treasury said, well, we needed to get it in place now because otherwise a whole year goes by and we don't get the 300 million we're planning to get in that year. But we will, of course, keep the interaction of DPT with the BEPS project under review. My guess is it probably won't change much. I think, actually, I hear over here that lots of people think the transfer pricing rules don't work in the US. Well, why not consider a diverted profits tax?
I was going to say, you've made quite the case for our Congress to enact a diverted profits tax.
It's just a very big cost.
That coupled with Michael's observations on how our revenues are going to get gored when we're the last ones to implement a hybrid regime, anti-hybrid regime, this may all cause our quiescent Congress to spring into some legislative animal. And what do we got here? So. With that, why don't we see if there are any comments or questions? I don't know. We have at least 5 minutes. If anyone has a comment, it's welcome. If they don't, we'll make Brett talk about transparency.
Better ask a question.
Brett wants a question. I'm happy with transparency.
Peter, can I ask you a question just on the topic you talked about on PEs? Because personally, I do believe, and there's been a lot of discussion in the UK about this, that an active warehouse, if actually you've got a choice between going online and getting a book this afternoon in your office or waiting till the weekend and going to your local bookshop, actually if your supplier couldn't deliver that afternoon and it was 2 or 3 days in the post coming from Luxembourg, let's say, then you'd probably go to the bookshop at the weekend because it's nicer. So personally, I do think that an active warehouse like that.
Well, we're just glad you're not a transfer pricing person because I see where you're heading.
Well, I practice a little. And the other one that I always find slightly strange, which goes into the same area, is that actually a purchasing agent is not a PE. And again, actually buying cheap is part of selling at a decent profit, isn't it? And having supplies. So I just wonder whether some of our concepts in our treaties are a little bit outdated, and perhaps today's when we got there by sail rather than by steam, rather than by plane.
Yeah, no, I think you're spot on, and that's certainly the thinking of the OECD and the members that propose those sorts of things. If you go to purchasing, they're thinking the procurement office, so where it's centralized procurement, a lot of value there, easy. It's worth that one's probably worth collecting revenue from. But if you just eliminate the purchasing exception altogether, it becomes a facts and circumstances test, and might be. I personally think you need, in some of these areas, it's good to have a safe harbor. It's much like you have in the diverted profits tax. You have a small, medium-sized enterprise exception, you have a revenue exception, and so forth. So I don't have a problem with eliminating it for the big guys, but.
Well, and of course, lots of companies are having transfer pricing disputes about procurement structures.
Are we?
Any
questions before we let this guy up here?
Okay. So with that, thank you, Peter, Michael, Brett, and Steve.